In this very spooky episode, I have some scary guests on: financial entertainers, financial gurus, government clerks, and IBC noisemakers. We had fun, and I hope you enjoy. Thank you for listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery, and we have a special episode for you today. This is the 2021 Halloween episode. We're trying to have fun. Actually, we are having fun in the midst of all the spooky things that are going on in the big wide world. I'm excited because we have some very special guests on today. We have several. We have financial entertainers. We have financial gurus. We have, governmental clerks, noisemakers. And like I said, we're having fun. I hope you enjoy it. Okay. But before we get going, a little note of history, right? And I wanted to bring up Pope Stephen VI. In 897 AD, Pope Stephen VI digs up his dead predecessor, Pope Formosus. I think Pope Formosus died several months prior. And Pope Stephen exhumes him, his body, his corpse, dresses the corpse up in full ecclesiastical regalia, and puts him on trial, right? Tries him, the corpse, and convicts him of heresy. That's about what we have going on in the big wide world today. Well, it seems like there was a dispute over banking and business, all right? The dispute kind of revolved around the oldest profession in the world and where those cash flows would go. All right. Thought it was very interesting. This argument of banking and who's controlling the banking function is very old, very, very old. And this is just one example how, things can go wrong. All right. And some of the shenanigans that comes from it. Okay. Our first guest is the financial entertainer. Welcome to the show. There's no need to say anything. I think I understand exactly who you are and what you do and what you promote. Okay. But we appreciate you being here. And my gosh, you look nice today. All right. Thanks for taking time. All right. The financial entertainer, they're typically found on the radio or public TV. They don't have a license, right? So they can, spew their information and their advice with immunity, right? Because they don't have a license. They're really, really good salespeople, though. I mean, probably the most well-known is a great advertiser, salesperson. I don't know what it costs to run a big syndicated radio program across the country and all the big markets in the U.S. and then all of the advertising that is sold in each of the markets. But good job, sir. Very good job. Of course, the arguments that they promote are very old. They can't lay them to rest. They just dig them up, rehash them, and over and over and over with drive-by innuendos and insults. Keep the argument going, right? These arguments. But some of the hallmarks are, they're arrogant. They're kind of a bully. Very arrogant. Did I mention arrogant? Condescending, they abuse their listeners and the preachers and the pastors and the congregation. But there's a certain amount of the Stockholm Cindies that love it. The financial entertainers always favor the market. They want you to put your money, your capital at risk in the market, because the market only goes one way. On Beinstrasse never goes down. All right. Nothing to see here. Just go find a 12% annualized long-term growth stock mutual fund. Yeah, and then cherry pick your time periods, right, to prove your point of that's where your money should go. And I think I did a PowerPoint presentation on that years ago, and I think it's still available. What the equivalent of that 12% long-term growth stock mutual fund is. I don't remember I should probably put it in the show notes, the name of that. But they always favor the market, right? And then they, of course, when it comes to life insurance, always, quote unquote, buy term and invest the difference, right? Number one, it's the cheapest way to buy death benefit. Yes, that's true. The cost of insurance Well, I don't want to say it is the cheapest, but it is one of the cheapest ways to buy a death benefit, right? Will it be enforced when you graduate at natural mortality? Yeah, who knows? What happens if you buy a 30-year term, in your 30s or your 20s, and then you become uninsurable? You had a couple of stents, or you got overweight and diabetes, high blood pressure, cholesterol, and then when that term runs out and you want some death benefit and you can't qualify for it. Oh, well, you should have been following the other half of the program and investing like no others, right? Living like no others so you can live like no others, right? And then if that doesn't happen, right, because it's very true, it's very real that most people don't invest the difference when they buy into this 100-year-old argument of buy term and invest the difference. Most people don't. Some do, of course. So if you don't do that, right, and you didn't become a millionaire and you still have a need for death benefit, it's always the consumer's fault, right? It was the customer's fault. Well, they didn't follow the whole program. Wasn't that convenient? Sure. I understand discipline is required no matter what program you follow, right? If you don't have discipline, Nelson said, you might as well go dig a hole and jump in it and have someone cover you up, right? Whatever you do requires discipline. I agree. But early in my career, back in 1991, I think is when I got my permanent life insurance license. And I had other financial licenses, still have other financial licenses to this day. But I bought into that program, buy term and invest the rest, right? They didn't create it. A.L. Williams didn't create it. Crown Financial didn't create it. It was, I don't really know who created it, but I got books from the 1930s that talk about it. And it's the same old argument, everything is focused on a rate of return, no question. And then the idea that if I buy life insurance, I can't invest or I can't do other things is not true. But if you narrow down an argument on one point, you want to live or die on one point, it's a weak argument. The idea that if I buy life insurance, if I practice the infinite banking concept, I'm paying high premium, and I'm trying to get a high cash value, without, jeopardizing the integrity of the policy. I'm not legitimate, correct foundation, correct structure. I'm going to build capital, and I have access to that capital. I can go invest in whatever I wish to, right? So the idea that you can only do one or the other, or buying life insurance precludes everything else or excludes everything else, so it's a zero sum, is not true. Okay, but it sounds good, right? Because you pay those big high premiums and, oh my gosh, the insurance agent's making commissions, and anybody that makes a commission's got to be a bad guy, right? But of course, all of the advertising that is sold across the country for big money, right? Big money. And then all the fees that you charge the endorsed local provider, and then all the fees that you want your customers to pay in those long-term growth stock mutual fund accounts. Those are okay. Don't talk about those. Don't look at those, right? Because they're not commissions, unless, they're going to buy your cheap term insurance that can't convert into anything through the company that, you endorse and enjoy revenues from. Those commissions are not very much because of this term. Those are okay. Right? And all of the other revenue streams are okay. It's okay for you to be a capitalist. Just don't call them commissions, whatever you do, of course. And then, of course, you got to disparage the life insurance agent's character. No question, because they're a scoundrel, right? Because they earn commissions. That's old too. Gary North and all his lackeys, they promoted that for years, and they did a pretty good job. But it all boils down to is grace for me and law for you. Right. Yeah. Grace for me and law for you. Of course. What's new? And then judging others by your own character. Okay. My encouragement is, listen, don't make financial decisions based on sound bites. Don't do it. Go ahead and take the opportunity, take the time, make the time to investigate for yourself this idea of becoming your own banker, that you can become your own banker. Explore the idea that you can control the banking function. And if you take the time and explore it, right, and you determine that it's worth implementing in your life, get to it. If you decide, no, it's too complicated or I'm not interested, no problem. But just take the time. Don't make decisions based on drive-by innuendos, soundbite accusations, all right? Just because somebody is arrogant, they come across confident, and they're bullying the listener, it doesn't mean they're right. Okay, but it's a hallmark, right? No license. Commissions are bad. The character of anybody who really does anything other than what they do, mainly life insurance agents, it's bad. And you got to buy term and invest the difference. And then, of course, they've got to villainize the life insurance companies, except for the ones they promote, right? They have to, they just have to villainize. The life insurance company's got to be a bad guy. And from my position, my opinion, what I've come to understand and believe, it's almost like the mutual life insurance companies are against the world when it comes to financial markets. And that pool of mutual companies is shrinking as we speak, right? Wonder why? Well, when you look, the mutual companies are with whole life, dividend paying whole life, dividend, participating policies. Produces a lesser return comparatively to term insurance and universal life insurance for the insurance companies. Right? So fewer and fewer companies want to make less whenever they can go write term and universal life and get a higher rate of return. So I'm just saying that the idea of becoming your own banker with mutual companies is worth investigating. Why a mutual company, James? Well, because the policy owner is the owner of the company. So all companies in the free world, and when we practice capitalism, companies are in business for two things, for two fundamental reasons. Number one, they want to make a profit. How do they make a profit? They provide services and products to their consumers, right? Well, if they don't do a good job and they don't get a government subsidy, they're going to be out of business, right? So they're incentivized to deliver good products and good services. Well, who's the owner of these mutual companies? Oh, it's a policyholder. Okay. So when the company has a positive financial experience in a given year, some of that revenue is shared with the owner through a dividend. Yeah. Okay. But then, they also argue that, dividends are just a return of a premium, overpayment of premium. Yep. That's how it's classified in the Internal Revenue Code. And that's okay. I don't care how you classify it. Just pay me a dividend. Yeah. Well, if dividends are bad, then you shouldn't buy dividend producing stocks, right? So it's okay to buy Home Depot stock, right? Ownership position, and not receive a dividend? Or would you want to receive a dividend? So would you want to be a consumer of and an owner of the same company? Yeah, I think so, especially when it comes to life insurance. I don't know about the other companies. But the insurance companies have to be villainized, right? It's very common to hear, well, the life insurance company keeps your cash value when you die. No kidding, right? Because the cash value is the cash value. The death benefit is the death benefit. Now, there is a universal life product, option A, level death benefit, option B, increasing death benefit. It's not complicated. Who's paying for that increasing cost of the death benefit? You, the policyholder. Okay, so let's don't cloud the issue or overcomplicate it because it really doesn't have to be. So what is a cash value? Talked about this many times. I've talked about these things many times on the free, no-cost videos that are available on my channel. It's okay to take time and learn or thoroughly vet the idea. Just check it out. See if this is an idea worthy of your implementation. If it is, great, get to it. If it's not, great, no problem, right? The cash value is the net present value of a future death benefit minus future premiums. So whenever you die, who keeps the cash value? Oh, wait a minute. The cash value is the net present value of a future death benefit. So when the death benefit is paid, that death benefit is made up partially of the cash value. Is that complicated? No. We don't even have to get it above third grade math. But let's talk about an example that I like to use. let's say you have a home that's worth $500,000 market value. You have $300,000 in equity. You sell your home for $500,000. Who, pray tell, financial entertainer, who kept that $300,000 in equity? What mean, evil, dirty scoundrel kept that money? Because we need to hunt them down, find them, and string them up, right? Put them on trial. Okay. Well, who was it? Was it the seller's agent that earns that dirty commission? All the hard work. You real estate agents, you realtors, you know what I'm talking about. Hard work. You earn every penny that you earn. And good job. Keep doing it. Okay. Was it the buyer's agent or the seller's agent? Who kept that? Was it the lender, the buyer's lender? Did they keep that $300,000 in equity? Was it the seller's lender? Who kept the $300,000, Mr. Entertainer? Oh, yeah, it's silent, of course. It was in the sales price of the home or the property. Okay. Well, if I had a $500,000 death benefit with a cash value whole life insurance policy of $300,000 in cash value, I graduate. My beautiful wife receives $500,000 income tax free, might I add. Who do we need to string up that kept that $300,000? Oh, it was part of the death benefit. Oh, okay. So these drive-by accusations, when you get all revved up and triggered, and by all means, I know how to get triggered, okay? When you boil them down, it's like cloak and dagger, smoke and mirrors, right? You got to vilify somebody to buy into your program. Okay, well, it obviously works, right? They're going to keep doing it. Why? Because it pays, right? Yeah, somebody's getting paid very well, right, Mr. Entertainer? Yeah. So why would they quit? They're not incentivized to quit. They're going to continue. Why? Because it pays well. Okay, fair enough. Another one, very common, is why would you ever pay interest to borrow your own money? Seems like a legitimate, fair question, doesn't it? Yeah, but it can't hold up under scrutiny and consideration. So it's either ignorant, right? Or there is knowledge. And then if there's knowledge there and they're not ignorant, then it becomes a moral issue because then it's a character issue. Okay, let's be clear. Whenever you pay a premium to a life insurance company, it is not your money. You're fulfilling an obligation, at least partially, because a premium is an obligation to the insured or the policy holder, the policy owner. You buy life insurance, it's a contract, all right? You're going to pay a premium. That's an obligation, all right? And the life insurance company is going to assume the risk of you dying too soon, all right? Because we're all trying to work and accumulate money for, passive income time in the future, for example. So if you die and you didn't have the time to accumulate all that capital, the death benefit is replacing that future income that died with you and paid tax-free to your beneficiary, right? Now, along the way, if you have whole life insurance, and I understand universal life does have an account value, and it's also called permanent, but I'm not talking about universal life. We'll talk about that later with all the other financial gurus, okay? I'm talking about permanent whole life insurance that has a cash value issued by a mutual company that pays dividends. Okay, I have that cash value. There's a loan provision in that life insurance contract where the owner has the right to collateralize that cash value. Okay. So whenever I pay a premium, that premium is no longer mine. It is not my money. It is the property of the life insurance company. Now, within that contract, a portion of that premium creates a cash value, and the cash value is guaranteed to grow over time. So as that cash value accumulates, that contract has a loan provision in it. So I can dang near demand one service form, one multi-purpose service form. And I can even go online now and request a loan. And I'm not asking the company to approve the loan. I'm not asking them anything. I'm telling them, this is what I want, and this is where I want you to send it. That's the only thing they ask me. If they ask me anything, well, do you want us to mail you the check? Do you want us to, deposit the check into your checking account? So let's be clear. That is not my money. All right, so I'm not paying interest on my own money. But it's okay if I did practice EVA, economic value added. It's okay for me to value my capital if I'm going to value the third-party lender's capital that didn't exist until I signed the dotted line, right? I mean, why would I pay a credit card 10, 12, 14, 15, 20, 30%? Or a line of credit 5, 6, 8, 10, and 15%? Or a HELOC at 3.5, 4, 4.5, 5, or higher? And I won't value my own capital? Yeah, there's some kind of a conflict of philosophy right there. Okay, so it's not my money. When I pay a premium, the life insurance company must put that money to work to meet future obligations. Well, what are those, James? Well, I'm going to graduate, and you are too. When? I don't know. And if I get mad and quit anywhere along the way and there's a cash value, that's an obligation to the life insurance company. If I live and get mad and quit, it's an obligation to the life insurance company if I die to pay the death benefit. So when I pay a premium, they have to put that capital to work to meet future obligations. I'm not even getting close to third grade math. I'm not. And so if they have to put that capital to work to meet future obligations, and I have first position access to that cash value as a policyholder. They cannot deny me a loan. If the capital is there, the cash value is there, I have a right to that. I can get mad and quit, or I can collateralize it, requesting a loan. Right? They have no choice. They have to fulfill the loan. Well, if they've had that money deployed, right, earning to meet their future obligations, shouldn't at least at a minimum, shouldn't they charge me whatever that capital is earning to meet those future obligations? Of course. Now, wait a minute. I'm the owner of the company too. If I'm a policyholder of a mutual company, do I want to steal peas? Do I want to practice dishonesty? Do I want to practice theft? Wouldn't it be theft if I got a loan from the life insurance company? For me, no, it wouldn't be stealing from me. Well, yeah, it would, because I'm the owner of the company. And then I would be stealing from all of the other policyholders that own that company, because it's a mutual company owned by the policyholders. All right, but listen, let's don't get all emotional about it. That's just financial, okay? The point is, it's not my money. The company has to charge an interest rate on the loan. Where else are you going to go borrow free money? Well, maybe call the financial entertainer or the financial gurus. Maybe they'll loan you money at no cost. Maybe your credit card will lend you money at no cost beyond that first, gimmick of 0% balance transfer. All right, where else are you going to go? Or besides your family? And then that's really not even loan. There's one thing that I was told last week in a conversation with a client. We were just talking about loans and things, and I said, listen, you don't loan your family money. Those are gifts. You don't lend them money. And he said, oh, that's a financial entertainer says that. And I didn't know that. So this corpse of a financial entertainer, I think that he agrees with that or promotes the same idea. Okay. I don't want to chase too many rabbits. I don't want to digress. The interest that you pay to the life insurance company, you're paying them interest because you're borrowing their money. You're not borrowing your money. So let's be clear. So that is in fact true. And so if you know that, then it's not ignorance, right? If you say it out of ignorance, you don't really know, so you have an opportunity to educate yourself. Okay, well, if you know and you say stuff like that anyway, then it's a moral issue. My opinion. Yep, and I'm entitled to it, just like you're entitled to yours. And if you're a financial advisor or guru, I'm not interested in your opinion, but I do appreciate you listening. Then, of course, it's always get out of debt first. Get out of debt first, then start saving or investing for your future income or what have you. Oh, great. It's like I have a Scotch-Irish background. And so I love Scottish history, right? And Welsh history and Irish history. And so Mel Gibson made this great movie. I'm not saying it's historically accurate because it's not, but it was a great movie, Braveheart. And so this one particular financial entertainer takes a clip out of that movie. Fabulous movie. Did I say I like the movie? I love it. Okay. And while Longshanks has William Wallace strung out, going to disembowel him, and he screams out in the movie, freedom. It's a great clip. I get it. I love it. And so it's great marketing. So they have this Freedom Friday, or used to, where people can call in, say, I finally got out of debt, freedom. And good job on the discipline of getting out of debt. Kudos, right? You need to get out of debt. And if you don't do something, who will? If not you, who? Dr. Seuss, right? If you don't, who will? Right? Okay. I was listening one Friday going home, and I heard an older lady in her late 50s. Her husband was even older, and they're calling in on a Friday. They're so excited. They spent the last however many months getting out of debt. They screamed freedom. And then she said, now we can start saving for retirement. And it was just piercing to the heart. It's like, oh my God, now you're going to start saving for retirement at age 57, 58. And it's okay. If that's how long it took, if that's how long you waited to get started, by all means get started. But sounds like you bought the wrong program for the first 57 or 8 years. And now you're going to make all that time up in the next, 30? I don't know. Anyway. Can you get out of debt by getting out of debt? Yeah, of course you can. Spend less than you earn, right? There's that discipline. But then what do you do with the capital? Is there a better way? There may be a better way to get out of debt than eating beans and rice, going without, and throwing all the money to the debt. Now, and I'm not saying there's a lot of illustrations and examples out there how to get out of debt with the infinite banking concept. That's one thing that you can do, no question. I don't adhere to that, right? Like this is what you do to get out of debt. That's one thing that can be done with dividend-paying life insurance structured properties to get out of debt, of course. But, if that's what attracts you to this, it's probably not going to end well for you. If you didn't have you just didn't accumulate all that debt because you have so much discipline, right? So if you, go get a HELOC and start a life insurance policy, create a bunch of cash value and borrow against that cash value to go get out of debt, and then all the credit cards are paid off. Now you got an outstanding loan, and what do you think the likelihood of running up all the balances on that credit or on those credit cards are? Very high. Okay, I digress a little, but yeah, you shouldn't be beholden to any third-party lender of any form, right? So you should be out of debt, no question. Let's see. I love the idea of trash value, though. Trash value. But cash is king. Aren't you saying trash is king? It's like trash value, and cash. It's like, man, get it straight, please. Don't confuse me. Bring up IBC to the financial entertainer and it's like, oh my gosh, IBC's a scam. And, it's a gimmick, right? Never combine your investments with your life insurance, which I agree with that. Right? I don't believe you should combine investments and life insurance. Oh, wait a minute. Life insurance is not an investment. It's not. Okay. That's why it's tax-free. Did they ever, any financial entertainer, ever in your lifetime, one time ever, mention anything about the banking function and who controls it? One time? No. They don't even know who's in the play, much less who the characters of the play are. They never mention anything about the banking function, who's controlling the banking function, or the idea that you legitimately can become your own banker and not be dependent upon third-party lenders. No. But then again, did they ever have any original ideas? Yeah, no, they didn't. All right, well, listen, thanks, financial entertainer, for coming on. You're just a small representation of the hordes of them that are out there. And you look good, by the way. You look very nice. So thanks again. All right, on to the next. Okay, in this segment, we have our friend, the financial guru. So he's representative of this, the typical financial salesperson. They have a license, right? And maybe multiple licenses and maybe designations and affiliations. They pay a lot of money for the right to use these designations and affiliations. And, and I don't want to paint with too broad of a brush. They're all bad people. I'm not even trying to convey that, right? I think most financial people have their consumers' best interest at heart. But they got to be paid. So they're typically, know-it-alls. Nobody really wants to hang around them. As a matter of fact, they're probably avoided. But they do have a license, right? And, they buy into the whole idea that, you need a qualified plan to invest in, and they have great algorithms and portfolio. They have a special portfolio design, and the market is the end all, the be all, right? When the market's going up, they want all of the prestige and the accolades and the acknowledgement. Hey, look what I'm doing for you. When the market goes down, then it's always like, well, what do you want from me? Right? The whole market's down. Everybody's down. It's only a paper loss, right? Just buy and hold. Well, how do you tell someone in their 70s buy and hold, right? You're young. You can recover. And then they're always chasing returns. It's always about the return. Return. They heavily promote, the tax deduction. Get a tax deduction today, right? So you can get a greater rate of return, get a company match. If you do this, if you save at least 10%, by the time you quote unquote retire, you'll be a millionaire, right? And you'll be in a lower tax bracket. Really? Well, which one of those two didn't happen? Never, ever a mention of who's controlling the banking function. If you talk about life insurance, there's only two. It's either term insurance or universal life stock companies. It's never whole life insurance. It's never whole life insurance with a mutual company, or rarely is it. There's a better way. There's always a better way. You can get a higher rate of return with universal life, variable universal life. The story just rarely changes, right? It reminds me, though, I was thinking, I did a little prep for the show, okay, which I don't normally do. I normally just walk in, sit down, and talk. I was born and raised in Fort Worth, Texas. Right now, we currently live about 20 miles south of Fort Worth. But back in the day, I don't know how far I'm going back. It's a long way, probably 20, maybe even 25 years. On the north side of Fort Worth, they would set up they'd rope off a square, and they would put different squares within this big square, and they would put a steer inside this area, and they'd let him, stay there for a day or two. And wherever he dropped his little cow patties, the squares inside that big square had different company symbols, right? And so there was a competition. I forget the guy's name, the steer's name, but the competition was all the financial advisors, the financial gurus that wanted to compete in this contest. It was they were going to devise a portfolio based on what their best estimates and guesstimates were, and it would be compared with the portfolio that was created by this steer walking around for a couple of days, dropping cow patties on different squares that are marked with company stock symbols. Think about this. All right. You know how often the steer's portfolio outperformed the financial guru's portfolio? I can't remember either, but it happened so often they quit doing it. Why? Because the financial gurus were getting embarrassed. The steer was beating. I perused an article a couple of weeks ago where some guy, created a mouse trap or a mouse maze, and he gave. However he did it, it was an engineer probably put it together, but every time the mouse would eat or do different things, it would buy cryptocurrencies, right? Buy or sell. And just the activity of the mouse outperformed most of these crypto guru traders, right? at the end of the day, you can't control the market, neither can they, right? And I always like to ask the question that, we use diversity to avoid or mitigate or minimize risk. And let me ask you this. Would you agree with me that a definition of risk could be the probability of loss? Yeah, I can agree with that. Okay. So the financial guru wants you to expose all of your capital as much as you can wrap your mind around to the market, right, at risk, the probability of loss. And the longer you do that, the better off you're going to be. Yeah, doesn't make sense to me either. When their clients bring up the infinite banking concept, the first thing out of their mouth is like, oh my gosh, that's a gimmick. Why would you ever do that? Commissions are high. You should buy term, or you should buy the universal life because it's much better, greater rate of return. And, I'm an expert. I've been doing this for years. As a matter of fact, yeah, I've done it for years. My grandfather did it. My daddy did it. His great-great-grandfather did it. We've always done it. Yeah, of course you can do that, and I can do it for you. But did they bring it up to you? No. Right. And do they ever talk about the banking function and who's controlling the banking function in your life? No, they don't. No. And so they make all these exotic plans based on the government, clerks, efforts. And we're going to talk about government clerks in a minute, estate planning, right? And this and that, and legacy planning. And I'm not disparaging all of them. I just want to point out some of the hallmarks of the typical financial guru. Number one, they already know. All right, they already know everything. Number two, they want your money in the market. And the longer you keep your money in the market, the greater the probability that you're going to win. And don't pay high commissions for whole life insurance. And surely don't compare their fees year over year over year for 30 or 40 years. Don't compare the totality of those fees and trading costs to the commission of a life insurance policy. No, don't do that. All right. And besides the life insurance agent, he's not properly licensed anyway. He's just a salesman. Oh, wait, you're a financial salesperson. Yeah, right. But the agent, you're going to disparage him for being a salesperson, right? And getting paid commissions while you're getting paid all the fees. It's like, that's the world we live in. It's like double speak, double talk, Don't pay attention to what I'm doing. Listen to what I'm saying. And all these drive-by accusations, innuendos. So you bring up the infinite banking concept. If they get past it's a gimmick, then it's like, of course I can do that. I can do it for you. But never bring up the infinite banking concept. So I know I'm dating myself too when I talk about W.C. Fields. He was a black and white movie days, right? He was a comedian. And in most financial arrangements, especially with investments or life insurance, there's three primary individuals, right? There's the entity, the brokerage house, the investment house, the insurance company. And then there's the promoter, the agent, the advisor, and then there's a consumer, right? And it should, in a good arrangement, should be good for everyone. You want the company to be profitable. You want the agent, the advisor to be profitable, so they're there to service you. And wait, does service even exist in the financial world? Yes, it does. And it should. Then there's the consumer, right? W.C. Fields said, well, the firm made money and the broker made money, and 2 out of 3 ain't bad. Who do you think that third one that didn't make any money was that W.C. Fields was referring to you to? It was you, of course. Thank you, Mr. Financial Guru, for coming by. You look really sharp in that jacket, right? Thanks for your input. In this segment, I have the government clerk on as a guest, and can't be more excited, right? Thanks for taking the time out of your busy schedule with all that productivity you're pushing out. I'm kidding. Listen, kids, don't forget, the government produces not one product, not one service profitably at all, nor can they. They confiscate private property under the threat of force and violence and then redistributes it. Right. That's your property. And I really wish these guys would be like Texas. Texas meets every 2 years, right? So they should do the same, in my humble opinion, in Washington, because there's only two things that are happening whenever they meet. They're eroding your rights and they're separating you from your property through taxation, right? Or fees or whatever you want to call them. They're all fees or they're all taxes. Well, listen, let's think about this. And I know we're talking about the infinite banking concept. We're talking about how you can become your own banker. So let's talk about banking for a minute. We can go all the way back in history, right? The root word of, I'm told that the root word of a bank is bench, because the money changers operated off of a bench outside the churches and the mosque. Okay. But I'm not going to go that far back in history for this episode, but I do want to go back to the War of 1812. Have you ever asked a history teacher, what was the cause of the War of 1812? Didn't we just separate a few short years earlier, and settled, with a war of independence, right? And then became friends. What happened? Oh, I don't know. The charter of the first Bank of the United States ran out in 1811. And we weren't going to reissue the charter. So our big brother, right, who we just separated from a few years earlier and made friends again, invaded us, burnt the White House. That's how the White House got its name, right? After the burning, then they whitewashed it. And then it was called the White House ever since. Oh, okay. Yeah, no, we never talk about that in history. And then along comes Andrew Jackson. And the second bank was chartered like 1816 or so, something like that. So that didn't last very long, right? Operating without a central bank. So the second Bank of the United States got started, and its charter ran out in 1836. And Andrew Jackson, a valiant man, fought the bankers. And then the panic of 1837 happened because the second Bank of the United States charter ran out in 1836 in the big squabble. So, okay, I digress a little bit, but thank you, Andrew Jackson. We appreciate that. No wonder they want to replace him off the $20 bill, too. Don't talk about banking, whatever you do. Okay, and then along comes the central bank that was established in 1913, right? The Federal Reserve Act, right? Created the Federal Reserve. It's not federal, it's privately owned, and there are no reserves, right? In addition to the Federal Reserve Act, a couple of amendments were passed in 1913. Terrible year for us, the middle class. The senators were appointed by the state houses previous to 1913, and then they become, elected at large, further centralizing power in Washington. And, that dadgum income tax. Yeah, trying to get the Spanish-American War paid for. Yeah, it's only going to be temporary. It's only going to affect the rich, right? Not you, the middle class. Never affects the middle class. It's always the rich. Got to sock it to the rich. Yeah, did you know it was 116 or so years later? I think it was somewhere along 2006. They got rid of a 3% surcharge on telecommunications. So your cell phone bill had a 3% charge on it, right? Since I think that happened in 1906, 1907 to pay for the Spanish-American War. But look, you just keep your head down and keep working, okay? Don't pay attention to all these little shenanigans that are going on by these government clerks who couldn't make it in the free world. So then we have the income tax. Okay. So, Nelson said it quite often, right? If the government creates a problem, onerous taxation, and then they come back and they create a solution to the problem they created, tax qualified plans. You'll get a tax deduction today to, diminish your the taxes you have to pay this year because they're onerous. We're going to cut you a break because we care for you. We don't want you to be dependent upon us in old age and Social Security. So we're going to give you a tax break today so you can accumulate a bunch of money for your retirement. Problem, onerous taxation. Solution, government qualified plan. Don't you feel like you're being manipulated a little bit? They have zero discipline. The government cannot restrain itself. The government the state, right, has no ability to restrain itself. You're not going to wake up tomorrow and hear them say, oh, well, we've been spending too much money. We're going to act like y'all and create a bunch of discipline. They can't, and they won't. So they're spending money that we don't have, and you know it. And so it's causing inflation, right? And then the onerous taxation. It's like, what are we going to do? Oh, okay. Then all the financial gurus come out and say, well, the only way that you can overcome taxes and inflation is you have to focus on a higher rate of return. You've got to go risk your capital so you can outperform inflation and taxation. Sounds good, right? Is it true? No, not necessarily. Not necessarily. You give these guys enough time, and they're going to continue to separate you from your private property. Right? They're going to continue to raise your taxes. Right? And if you don't pay, it's under threat of violence and force, right, that they'll make you pay. You know, what, a $3.5 trillion spending bill that they haven't read, can't read, won't read. I'm sure some of them can read. They're attorneys, right? So they got to read. But they want to find out where you're spending your $600 at your bank. Oh, and they're looking at the step up in basis with real estate. They're going to eliminate that, a step up in basis, really? Oh, okay. Yeah. Oh, wait, and they're going to lower the estate tax exemptions. Yeah, they change all the time. Well, it keeps the legal firms and the legal disciplines, moneyed up pretty deep, rewriting these estate plans every time they turn around and change them. What else are they coming up with? Oh, yeah, the unrealized capital gains. Right earlier, the financial guru said, well, it's a paper loss. It's not a real loss until you sell it. You're going to create the loss. If you're, what I'm referring to is let's say you have $100,000 investment value, the markets go down and the statement now says you've have an unrealized loss of $50,000. So now your account value is $50,000. Well, it's only a paper loss. It's not realized until you sell it. Once you sell it, then you've locked in the loss, right? Okay, that's a good thing. That's why I want to put more money into wherever I can potentially lose a ton of it. So the government clerks up there get together and say, oh, well, we've got to raise more revenue, right? Because we don't have any discipline. And we want to control you. Okay. Yeah. So we're going to tax unrealized capital gains in your portfolio. Well, but it'll only affect the rich, right? Just like the income tax originally, you probably could have made about $120,000 in today's dollars without paying any tax. Right, and then the cap was only 7%. I'm going back to 1913. That's on our website and some of our videos. I've talked about it many times. My point here is that, if they do these things and you give them enough time and they're going to do them, right? Well, the unrealized capital gains isn't only going to affect you. It's going to affect all of us, right? Not just the rich, because then they'll apply it to the mutual funds and the exchange traded funds, right? So just think about that. You put $100,000 in the market, it goes up 150. They're going to charge you income tax on the 50, knowing full well that market could go right back down to 50. So you paid tax on money that wasn't even realized. What a concept. Yeah, it's good for them, right? Of course. Look, you just keep your head down, keep working, put your money in a long-term growth stock mutual fund and hope it performs enough to outpace the taxation and inflation that they are creating, right? There could be a better way. There may be a better way, right? This idea that you can become your own banker with dividend paying life insurance, high premium, high cash value. There's no gimmicks here and there's no deals in the life insurance world, right? But legitimately, can you build a life insurance policy, the death benefit of which is tax-free, and have access to this cash value that's accumulating properly, tax deferred internally? Yes. That's accessible, tax-free? Yes. All right. And then I don't have to worry about what the interest rate environment is because I can't control that either. and I don't have to worry about what the market's doing or not doing because I can't control that either. Let's don't even go down the rabbit hole of every market on the face of this planet is manipulated, right? Did you say that, James? Not out loud. All right. The YouTube algorithm will, run the AI will figure out what I'm saying. And so that's why I use a Southern drawl, right? To trick the AI. These guys need to quit hanging out is what I think. Or maybe we need to look around and take action, right? At the you and me level, right? You control the banking function at the you and me level. All right, Government Clerk, I can, go on. And I'm surely I have a few good things to say about you, right? Protecting the borders, right? Or, protecting the God-given rights. Yeah, no, I spoke too soon. I don't have anything good to say. Well, who'll build the roads, James? Same people that build them now. They'll just do it cheaper, more efficiently, and I'm sure they'll last longer. And all of your cronies and your family members won't become billionaires on your $200,000 a year salary. I digress. I'm talking about the infinite banking concept. You can do something at the you and me level to disengage from this pre-constructed system, right, of putting your money into the market and being at the whim of these government clerks, right? You can do something different. And so this idea of becoming your own banker is worthy of your investigation. And you're not asking for approval. Look, life insurance predates the Internal Revenue Code. Right? There's no gimmick here with this life insurance. We're not practicing in the gray area. We're not making something, to avoid taxes. We're not doing something. It's not a tax loophole for the rich. This is a legitimate, systematic way to accumulate capital that you have access to by guaranteed contract. Wait, the Constitution is a contract. Now, I'm not saying that they won't shred contract law in some time. Give them time. They'll shred everything, right? But until then, we strive to live free and independent. And you can't have freedom without financial freedom. You can't have financial freedom without money, without capital. So what should you do with your capital? You should look at the infinite banking concept. Becoming Your Own Banker by R. Nelson Nash. Building Your Warehouse of Wealth by R. Nelson Nash. The first book, Becoming Your Own Banker, is now on video or audio, right? And Banking with Life DVD, that's available. How Privatized Banking Really Works, that's available at the infinitebanking.org, not infinitebanking.com. Another huckster just trying to, play off the name and mimic Nelson's work and not give him any credit. You can go to my website, bankingwithlife.com. Those books are available there. And then Nelson's recorded live presentation is available at the Nelson Nash Institute. It's also available at our website, and we'll give you a discount. So thanks for listening. Thanks for coming, Government Clerk. And I hope you get everything that you deserve, sir. Everything that you've earned. All right. I'm having fun. Okay. All right. We're cooking with grease now, man. All right. In this segment, I have the IBC Noisemakers on. Now, these are typically self-appointed experts that have a life insurance license, and they can spell IBC. So whether they've changed careers, some real estate gurus, or the last housing collapse, they were mortgage brokers, selling loans, selling cheap money, had to change careers or whatever. Maybe they had been in the life insurance previously, in the life insurance business previously, and weren't very good salespeople. And now this is a way to sell a lot of life insurance. I don't know their background, right? But I can spot their hallmarks. And you probably can too. As a matter of fact, I know that you can. And let me say that, I'm having fun, right? I'm just pointing out some of the things that you see over and over and over, and you just get tired of, and it's Halloween, and it's spooky, and this is spooky, so we're spooking it up, okay? All right. They typically have done it for years. Oh, yeah, I've done this for years. The hallmark is They're an expert. They're self-appointed experts. They have, typically ClickFunnels and all kinds of programs that if you'll buy that, you'll become a millionaire overnight. And without a doubt, they rarely mention Nelson Nash, or they on purpose avoid mentioning Nelson Nash unless it's just a cursory acknowledgement. Yeah, we appreciate Nelson bringing this whole infinite banking thing to light for all of us, but now we can improve it. We improve it. This is how you make it better. This is how you make it better. Whether it's with a fabulous spreadsheet or a presentation, or they have some bolt-on things. There's always an improvement, and rarely do you find them trying to get to simplicity unless they oversimplify, right? There's only one way to do it. That's a oversimplification. That exists out there as well. But regardless of who they are, the hallmarks are they can do it better. They've, spent 2 months learning from all the experts, and now they've, come up with a book that is really printed transcripts of videos that have been out for years and then published, and, don't give anybody credit. But they always have to make it better. They promote dependency upon them or their programs or their software, right? They'll mesmerize you with spreadsheets and presentations, whether it's on the whiteboard or wherever. Rest assured, they almost invariably violate Nelson's 4 basic fundamental rules, right? But they always say things like, you only want to do this with the big 4 insurance companies. Wonder why? Probably because that's who they write for, right? And maybe there's some household name recognition with the companies that do not like the concept. Right. And they do not like to, if you want to find out whether they like the concept or not, just call up the regional vice president of any of the big 4 companies and ask them their opinion of the big 4 or the infinite banking concept. Go ahead and ask them. Right. Ask the people who are inside that know the life insurance companies in the industry. Ask them. They'll tell you. These big companies don't like the infinite banking concept. They think it's a sales gimmick, and they probably are angry because they didn't create it, right? But then again, too, you almost can't blame them because you have all these, people out there promoting all kinds of who knows what, right? And calling it the infinite banking concept. I can see why they don't necessarily embrace the idea. And besides, they don't want you exercising your contractual right through that loan provision and, borrowing against the cash values. They got to rename the program some way, right? Whatever their name is. And they got to boil it down to, a structure, how much on a percentage basis of a premium goes to the base whole life policy, and how much goes to a term rider or the PUA or the blended PUA and term coverage component. And they got to squeeze the base down to nothing, right? Because you got to have all that cash value in the first year or 2. And so they say, well, this is right. 90-10 is right. Or no, this is right. 80-20 is right. Or no, 70-30, that's right. And then, 60-40 that's right. Or 50-50, and 60-40 is wrong, because that's what Nelson did. And then they compare, 90-10 to 60-40, like 90% to the PUA is bigger than 60% to the PUA. No kidding. I'm glad you can do some 3rd grade math there. They illustrate things like, paying 4 years and then premium offset, making the premium or the policy pay for itself, or they do a RPU, reduced paid up in year 7, 8, 9, or 10, or, or they bring in HELOCs, you go become dependent upon the third party lender because you don't have any money, right? You don't have any discipline. So go borrow against, your house, your number 1 primary asset, where you live. Borrow against that to come up with a premium and then pay premiums for 3 or 4 years. And then, you can't get that loan. Oh, well, we know some lenders that they'll give you the loan. Yeah. And, and I get paid there and I get paid there and I'm sharing revenue streams with everybody else that's touching all your money. And I mean, it's just, and let's complicate the fire out of it too. That's another hallmark. They want to complicate it. Well, we got to get a HELOC. So then you can buy the high cash value, life insurance, and then you got to leverage it immediately and put that money to work. And so you go buy some turnkey real estate, right? Because real estate values go one way forever, right? You got to do that. Or, you got to go start an LLC. You got to go start a company and then do a qualified plan within the company. And then, you're a sole proprietor. So then you can borrow against all of that, the company, and trying to avoid taxes. But, they get paid there, they get paid there, and they get paid there, and then they get paid there, which I'm a capitalist. I'm not opposed to, profits. But dang, how convoluted and how many revenue streams do you want to, drag your customers through? I know how many they want you to drag them through, and that's about zero. Or they come up with, whole life that's antiquated. That's all old. And, you got to do this new universal life because it illustrates better. It's going to do better. No, it does illustrate better. No question. And it's very profitable for the life insurance company too. Just like term is very profitable for the life insurance company. Why would that be, James? Well, I don't know. Maybe 97, 98% of all term life insurance never pays a claim. You mean somebody outlives the term, the 20-year term, the 30-year term? Then they die natural mortality? Yeah, what a concept. I wonder, do you think the insurance companies know how to build policies actuarially? Yeah, they do. They don't know who's going to die when, but they know how many 55-year-old males are going to die this year, how many 25-year-old females are going to die 10 years from now. They're very intelligent, no question. The best actuaries, Nelson used to say, are from Sicily, right? They can tell you who's going to die, how, and when, right? Okay, so we got to convolute things. We've got to complicate things. And, I understand some people are attracted to complexity, right? So if I'm going to, put a jacket on or, stand in front of an airplane or, put together a great big spreadsheet with all these moving parts and, drag you through that. And I speak with some authority and, I have a life insurance license. I don't know anything about life insurance, but I have a license, right? And I became a life insurance expert because I spent 30 years as a chiropractor, right? Or 25 years in the real estate business or whatever. But, in 2 months or 6 months, I'm a life insurance expert and have a life insurance license, and I know how to run a spreadsheet. And I can put together all these great big, complicated, appealing scenarios where you'll be rich quickly, right? And always live tax-free. Oh, wait a minute. Go down and borrow in the lowest interest rate environment ever. Money is cheap. Yeah, no question. Here we are in 2021. Money's floating off throughout the economy. You know as well as I do. Go buy an automobile. Go try to have a pool built. Right? Go buy a piece of farm equipment. It's like you can't find it. Oh, the supply chain. But nobody's working. Where's all the money coming from? Yeah, interest rates are going to remain low forever, right? So I want to, and I've said this many times, it's kind of a pet peeve I have. Can you borrow against a life insurance policy? Of course. Can you go use a HELOC? Of course. You can do anything you want with property that you own, right? That has a value. You can give it away. You can collateralize it. You can do whatever you want. Should you? All American family, all American business owner. Should you go collateralize the most valuable things that you have, your business, your home, a well-designed life insurance policy? Go hawk that, go collateralize that with a third-party lender and let them control that. Yeah, becoming your own banker. So the hallmarks are pretty clear. They violate Nelson's 4 fundamentals, and I'll get to those. But here's some real quotes that I've seen myself and my clients and prospective clients have sent from these IBC noisemakers, right? A direct quote. I tell my clients that they can keep taking money out and it just doesn't matter because it just keeps making more. Really? I mean, really? Yeah, okay. How about this one? Whole life is a superior savings vehicle, but it is an inferior, caps, screaming, lending vehicle, exclamation point. I credit Nelson for bringing this whole IBC thing to light for all of us. Cursory acknowledgement, right? But let's face it, the method of borrowing using your loan is archaic and misleading. Turnkey lending programs for whole life offers lower rates. So these other turnkey lending programs, they offer lower rates. Okay. Plus some cash value lines of credit programs even offer the last remaining advantages that policy loans boast: privacy, simplicity, flexibility, and the ability to roll up rather than pay interest. Man, doesn't that sound educational? I don't know what it sounds like, but it sounds like a red flag to me. So it's archaic, really. I have an asset that I can collateralize with one signature, two if I'm married or in a community property state. Or I can even do it over the phone within certain limits. That's archaic, and it's still going to sit there and increase in value. What's archaic about that? Privacy, who knows about that? No one. Really? You got something that's even more private than that? Really? Oh, okay. You have something simpler than that? Really? This bolt on, to Nelson's great work. You're going to bolt this on and improve it. It's like, yay. And people buy this. People buy this stuff, right? And then, of course, probably using a direct recognition life insurance company where the dividend is actually and factually reduced on the outstanding loan amount or not paid at all, right? Yeah. I would rather work with companies that actually pay a dividend and that are non-direct recognition, that don't mess with or adjust the dividend when there's an outstanding loan. But, these New York companies that are direct recognition, right, that reduce the dividend when there's an outstanding loan, they've trained their agents for years how to, encourage and educate your policyholders how they can go down to the bank, your friend. You need to go cultivate that relationship, right? So you can borrow the bank's money at a cheaper interest rate. So you receive the full dividend, the money's cheaper, and then everything is hunky-dory, right? So the agent with these direct recognition companies, a company that reduces the dividend, they're trained, and they sometimes they accidentally discover these things on their own, right? I've done it. I've educated bankers. It's like, listen, if you have these companies and they're household name companies, life insurance companies, if you have consumers or a consumer of that life insurance that is going to reduce the dividend, could be a prospective client for you, Mr. Banker, because you can lend them money cheaper than they can borrow it from the life insurance company. And they'll collateralize that loan with a fabulous asset, dividend paying whole life insurance. And then, of course, I encourage the banker, if you ever have to foreclose on that, right, repossess that policy, call that note, I'm a buyer. Right, yeah. Okay. So can you do all that? Sure, I can do all that. Of course. Can I go start an LLC and try to get a bunch of tax, deductions and then start a qualified plan and put a life insurance policy in the plan? Yeah, I can. Oh, wait a minute. So I'm going to get a tax deduction now, and I'm not going to forego tax treatment later in a tax-free life insurance policy. The death benefit's tax-free. The cash values are accessible tax-free. Tax-deferred until you access them through a loan, then they're tax-free. We can complicate anything, and complexity doesn't mean that it's not fragile. As a matter of fact, the more complex something is, the more fragile it is, right? So we can overcomplicate. And we don't have to. And most of the IBC gurus, noisemakers, they love to complicate it or oversimplify it to where this is the only way you do that. 90% to the PUA and 10% to the base, where everything looks the same. Everybody looks like a nail and you have a hammer. Oh, it gets old. And I know it gets old for you too, because as soon as you are exposed to the idea of the infinite banking concept and you click on a few things, then you're stalked to the nth degree. I mean, these guys pay big money to stalk you, right? And God bless them. I guess it works. Of course it works, or they wouldn't keep doing it. So, or you can just like, thanks a lot, and read Nelson's book, Becoming Your Own Banker. None of that came from Nelson Nash. None of it. So this idea of, buying one policy, I have a quote in here somewhere that the gentleman is, let's see, what did he say? He asked a question. He's like, well, now if I buy my first policy, if I put $35,000 in my first policy, can I immediately take a loan for 90% and buy a second policy? And on the second policy, can I immediately take a loan for 90% and buy a third policy? And aren't I receiving triple compounding? Yeah. And you've got 3 outstanding loans that are compounding against you. Where do you think he got that from? It's called stacking or laddering, right? The IBC Noisemaker calls you in year 2 or 3 and says, well, now it's time to take a loan. For what? To buy your next policy. For what? Well, so I can get paid. Oh, yeah, he didn't say that. So I'm just saying there's some easy identifiable hallmarks, right? Number one, they're not promoting what Nelson did. They're perverting what Nelson did, right? And they're not giving him credit. They take every opportunity to meticulously build an illustration. They'll build them with preferred rating class, right? They'll figure out what the MEC line is, and they'll manipulate the duration of how long you pay a premium, right? They'll do everything that they can possibly do to make that illustration look the best that it possibly can look, right? And you probably don't know what's going on behind the numbers on that illustration. And then if you compare, when you send them illustrations that you've requested from, a life insurance agent, which this is very old in the life insurance industry, right? You got to beat each other up in their character, and you got to beat the company up, and then you got to beat the illustrations up. Well, whenever you send them an illustration, they probably know how to build an illustration. Of course they do. And so they meticulously massage the numbers on a page to make their illustration look better than the one you own or the one you sent them. I mean, really? So if you make a decision based on numbers on a page, you're probably not going to be happy. And my encouragement is, you get all that you want. Some of this noise you cannot get off of you, right? So once you can recognize the noise, you should avoid it, right? But, and I understand too, there's a lot of listeners to this podcast that are, these financial gurus. I understand. And so I'm educating them as well. So, it's okay to listen and learn, okay, and to compare. Another hallmark of the IBC Noisemakers, it's always about a rate of return. Always. Get a 4% guarantee, which is hogwash, and you get a 5% dividend. You would think that would be a 9% rate of return, right? But if you put 100 in, you built at 90-10, and you only have $89,000 in cash value at the end of the year. What happened to that 9%? 4% guarantee and the 5% dividend. Right. I mean, if it sounds weird, it probably is weird. Let's see, the big four. I've already talked about the big four, right? And I love to say it, it's like the big four. What does that mean? The most square footage of office space that they're not going to need or work from because they've sent all their underwriters to work from home and all the buildings are empty now, but they're still paying for it. They pay the biggest dividend, right? Or they illustrate the biggest dividend and then don't pay it. Are we talking about the waist size of the president, the vice president, and all the regional guys? What are we talking about? Are we talking about the biggest surplus bond that they have on the books? The big four has the largest surplus bonds. It's like, it sounds good, doesn't it? Well, you should only do business with the big four. And these smaller companies, these tier 2 or tier 3 or whatever terminology they invent, right? that sounds good. Whatever they use, say, oh, these smaller companies like $100 billion company is a small company, right? Or, if 90-10 is good, why ain't 97-3 better? Oh, well, we can only do that with the small companies. We don't typically do that with the large companies. Yeah, of course you don't. Of course not. And I want to say that this channel has a lot of material, content available at no cost. The Nelson Nash Institute has a lot of content at no cost. But then again, look, your education, which we all pay for our education, right? Just how many mistakes cost you money, right? You're going to pay for your education one way or the other. I want to encourage you to read Nelson's book, Becoming Your Own Banker. Read his second book, Building Your Warehouse of Wealth. And then the Banking with Life DVD. And then the Nelson's live seminar recorded 6.5 hours on DVD. That's available. That's a great foundation to build your education upon. All right, don't make a decision based on these drive-by innuendos, these exciting, mesmerizing, but confusing presentations, right? It's worth your time and effort to discover this idea and to vet it to see if it is worthy to be implemented in your life for your benefit and for the benefit of your family. And let me say this. I want to be very encouraging. Once you lay the correct foundation, a properly structured policy or a series of policies that will serve you well over your whole lifetime, that's what you want. You don't want a policy to make in year 8 or 11 or 20 or 30, right? You don't want to be forced to go into underwriting every 5, 10 years, 15 years. You want well-structured policies that'll serve you well over your lifetime. And you don't want to contort a policy to get artificial value in the early years. Early cash value is important, no question about that. But you don't want to sacrifice a future policy year for artificial efficiency. So educate yourself. And I do want to say too that, this idea, once you put your hand to the plow, you start paying premium and you're working with competent people that really have your best interest in mind, that are knowledgeable, that are not practicing on you. This idea of missing out, this fear of missing out, this FOMO goes away. Everything walking down the street is not an opportunity. Nelson had it exactly right. When you have capital attracts opportunity. These opportunities that are created to attract your capital is backwards. That's what Wall Street does. Here, let me create this great opportunity to attract your capital. No, your focus should be on discipline, accumulating capital. Not there. The opportunities will be attracted to you because you have the capital. The capital is attracting the opportunities. And the further you go, the idea that you're missing out, that this fear of, you're missing out on these great, rags to riches illustrations and examples goes away. It goes away because legitimate opportunities present themselves and your ability to identify an opportunity increases and improves. Yes, there's a certain amount of confidence that policies give you, the owner. In closing, I want to say a couple of things, right? None of them, the government clerk, the IBC guru, noisemaker, the financial guru, the financial entertainer, none of them address who or even ask who is performing the banking function. Banking exists. Banking is, and somebody is going to perform that function and profit very well from it. And it should be you, right? Nelson said that, and I agree, we should all be in 2 businesses, whatever it is we do for a living, and then we should finance that, right? And even if you don't have a business, every home should finance the operation of the home. Right? The homemaker, the home, that's an entity. It should be run like a business. I'm not saying you shouldn't have fun. You should have a lot of fun, but it should be run like a business. And then that home should be financed. All right. And when the focus is on the banking function, you'll wind up with more death benefit than you can get past the underwriter. You'll wind up with more death benefit at natural mortality than you ever sought to purchase. Oh, wait, and you'll affect more than one generation. You'll affect your children, your grandchildren, and even their grandchildren. I'm telling you, right? Well, so you don't have family. Okay, all of these entities and organizations that you love and care about, you can affect them beyond your lifetime. Right, and you can also enjoy tax-free passive income. Right, okay. I'm not saying it solves all the financial problems, but it sure doesn't complicate any. All right, and it goes a long way to, addressing most of them. And so I want to close with this, the 4 fundamentals that Nelson left us with. And simple, yes. My gosh, if we need simplicity, it's today. If we ever have needed simplicity. Number 1. Think long range, right? Think past next week. Think past your retirement. Think past next year. Think past next month. Think past 10 years from now. Think long range, right? Whenever you have to have access to every dollar you paid in premium, you're not thinking long range. You're not. Number 2, don't be afraid to capitalize. i.e., don't be afraid to pay a premium. If you have to have access to everything that you paid in premium in year 4 or 5, you are afraid to pay a premium, and you shouldn't operate in fear. Okay? Number 3 is don't steal the peas. Be an honest banker, right? If you make a loan, have a loan repayment plan. This idea that you can keep taking money out forever and it doesn't matter because it keeps making money is hogwash. Right? If you make a loan, if you request a loan, if you get a loan from the life insurance company, have a loan repayment. The only time that you shouldn't have or you may not have a loan repayment is when you're in passive income and you know full well the death benefit is going to repay the outstanding loan. Other than that, every loan up until then should have a loan repayment or you're not practicing honest banking. Right? All right. And then don't do business with banks outside of a savings and checking. Don't be dependent upon a third-party lender. If you have to borrow money, if you have to collateralize your life insurance policy with a third-party lender, you're violating that. Number 5, rethink your thinking. Nelson added the 5th one, a couple of years before he graduated, and rightly so, right? Because all of this, the financial entertainers, the financial gurus, the government clerks, these IBC noisemakers are promoting flawed thinking. They're promoting and violating every one of these 4 fundamentals. Their flawed thinking is continuing, and that's what they're promoting. And if you buy into that, you can't hardly get it off of you, right? Okay, rethink your thinking. I like it. I have a quote, it's attributed to Thomas Edison. Did he say it? I have no idea. I like the quote. I want to share it with you. 5% of the people think. 10% of the people think they think. And the other 85% would rather die than think. You're the top 5. Act like it. Okay. Listen, I had a lot of fun here. I know I'm making fun of characters and personalities and philosophies and nobody individually, everybody in general that promotes the noise, right? So don't be offended. As a matter of fact, if you are offended, you're probably a promoter. You've self-identified, right? And I appreciate the listeners and everything that you share with me. I appreciate the questions and keep listening. Keep sending the questions. I don't know everything. I'm teachable. What a concept. I am teachable. So if you can educate me, by all means, please educate me. I just want to say thank you for listening. I had fun. I hope you enjoy it. And avoid the noise if you can. Identify the noise and sidestep them quickly. It'll save you time. It'll save you money. And it'll save you a lot of heartache. My opinion. All right. Thanks again.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.